All right, team. So this podcast is actually a recent webinar that we did with a Kiwi-based company for free of charge. Now, if you would like us to come into your workplace and talk about financial well-being, reach out via the link below. And remember that this podcast is actually best viewed on video.
We're back in your life with another webinar. Today we're talking about retirement planning.
Thanks for taking some time out of your Thursday to talk about retirement. For everyone who hasn't heard of us before, we are Lighthouse Financial Services. This is James Blair, financial advisor to the stars. My name is Michael Vincent. I'm also a financial advisor. I specialize in mortgages. James likes to call me a mortgage broker, not to the stars. And basically, we've got an hour today to run through everything to get you ready for retirement, right? And really important things for this this webinar is everyone is at a different stage financially with their financial literacy, what they're looking for, from this webinar probably. So we will talk, but I think where you're really going to get a lot of the value is in the questions. So make sure you're chucking questions in the Q&A section. Don't put them in the chat section, put them in the Q&A section, and we'll answer them at the end. Our mission at Lighthouse is very simple. We want to secure Kiwis' financial future, right? And what is our equation for that? It is education plus action equals financial freedom. There's a little bit of time in there in between the action and the financial freedom, but that's the basic outline. And you'll hear us talk about taking action quite a bit today. This is not a high pressure sales call. This is not the Wolf of Wall Street or something like that. Taking action is just about it may be you review your KiwiSaver provider, or you set a budget, or you take some small action that's going to get you a positive outcome in the future.
If you pay for our premium financial advice subscription, you can skip the time piece, get right to what you want.
Cool. So here's a bit of our vanity slide. We've taken about 9,000 Kiwis through these events. 95% of attendees recommend us. The other 5%, I don't really want to know them. Some of the companies we've worked with, Samsung, Rocket Lab, Colliers, you can see it all there. This is just to say, hopefully we know what we're talking about, and this is a little bit of why you should listen to us.
We've also been doing webinars with Engineering New Zealand for at least 3 years now, I think.
Yeah, absolutely. So I said before that James and myself are both financial advisors, so we do have to give you a disclaimer. Now, this is not personalized financial advice. We are just talking in general terms. I spoke before about that Q&A section. Throw heaps of questions in there. We'll try and answer them all, though we do have a hard stop. But if you start asking questions like, I'm 30, my partner's 35, I earn X, they earn Y, what fund should I be in? What house should I buy? Am I high risk or low risk? That's personalized advice. We can't do that on this call. We don't know you well enough to give you accurate advice. Don't roll your eyes, James. It's recorded. So we can't give you personalized advice. We will come very close to giving you personalized advice, but we can't do it on this call. And if you are thinking, I do want to ask those questions, just book in with us afterwards. We don't charge anything for the initial meeting. So we should be able to give you some advice on those calls. What are we going to speak about today? So this is all about getting ready for retirement. So our discussion points, setting goals. If you don't know where you're going, how do you know if you're getting there? Planning for retirement. What are the things you need to think about when you're planning for retirement? Where are you at? What are the actions you can take? And then the all-important question, how much do you need? Right? And that's different for everybody. So we'll run through that really quickly. We're then going to talk about investing. What are the different things you can invest in? Are they good? Are they bad? Are they ugly? Does it depend what stage of life you're at? So we'll run through all about that so that you can hopefully make some informed choices off the back of it. And then our favorite piece, the question and answers.
Yeah. So the reason we do a webinar where we talk about retirement is, and especially right now in terms of cost of living, recessionary, conditions, it's a bit tough. People are worried about retirement. 2/3 of, Kiwis are worried about money. I'm pretty sure that stat has gone up.
Yeah.
Yeah. And the other one, which I think that set's probably a little bit low as well, is so one of the vehicles to help you get where you want to for retirement is your KiwiSaver. And I would say somewhere between 1/4 and 1/3 don't know the balance of their KiwiSaver. Probably close to 40% haven't made an active choice of the provider or like what level of risk they're in, the contribution levels. So that's why we're doing this today. Now, with this group, I can guarantee it that there will be people on this call who are 20 and there will be people on this call who are 60. So very wide spectrum. So we're going to be talking about retirement, getting ready for retirement, how to think about it. But everybody's a different stage of financial literacy, different stage of life. So please try and apply the principles apply to everybody. Okay, so the best time to start investing was yesterday and planning for your retirement. The second best time to start is today. However, the earlier you start, the less you will have to sacrifice in the future. We talk a lot about action. We talk a lot about a bit of time. Action plus time is essentially compounding returns, whether it's property, whether it's investing into shares. We are not just having to save our money, but we are getting a return on our money. So for those who are in their 20s and 30s, time is a huge asset for you, really something to try and make the most out of. But if you are running out of time, what some people do is they put their head in the sand and they go, it's too hard. I'm not going to get where I want to get. I'll just enjoy my life and money runs out whenever it runs out. There's actually quite a lot you can do with the period of time that you have. So that they're probably like the time frame is a huge component, but it is not everything.
Yeah, and when we're talking about time and the kind of the steps we take, small consistent steps over time are going to get you where you want to be. Everyone's time period is different. The earlier you start, the less large their sacrifices are on a regular basis. So again, to James's point, a lot of people put their head in the sand with this. James, when would you say people like usually come to see you to start planning for their retirement? What age do you think they're at?
50 like is pretty good. I love it. If there's a couple that are in their like early 30s, it just becomes so much easier. But then on the flip side, I've had a couple come to me at 65 and they've been able to retire at 67. 60, and they were able to retire at 67. It really just depends on a whole range of different factors. Cool. So the other big component is goal setting, right? The reason why retirement advice, financial advice exists is one size does not fit all. You will talk to your friend and they will give you advice that worked well for them, but that might be completely the wrong advice for you. So money is just a tool to help you live the life you want to live. And the whole thing, it's a balancing act between living your best life now and setting yourself up for the future so you can enjoy that lifestyle as well. Now, the only way to work out the right strategy for you is to set the right goals. There are quite a few ways to set goals and some are better than others. So we have some data to back up some different ways to set goals. So Mike, this is a study from the University of California with 5 different groups and how they set goals. So let's go one for one through them.
Cool. So group 1 asked to think about a business-related goal that they hope to accomplish within approximately 4 weeks of time.
Cool. Group 2 did a little bit more. They wrote it down and rated it in terms of difficulty.
Group 3 was asked to write some type of action commitment for each goal.
Like in our process that we have. Group 4 did the above, plus they shared those commitments with a friend, so they had some accountability.
So group 5 did all of the above and also sent a weekly progress update to that person.
Cool. So, I mean, these are like pretty straightforward. There's nothing crazy about this, but the group that thought about I should do something better in terms of my, financial future, my retirement, 4 and 10 got where they wanted to, opposed to the last group where there's weekly updates being given back. 3/4 got where they wanted to get to. So we play around with the fringes all the time. And we talk about like, do I buy an investment property? Should I invest in this particular share? I'm thinking about, doing rent investing or setting up a business, doing the basics and having the right structure of going, where am I going, and keeping myself accountable. I mean, look at the results. Cool. I think the other thing to talk about as well, when you're thinking about your retirement, is everybody's different. So like I talk to people about financial plans, retirement plans every day, and there's kind of 2 camps of people. There's those who go, I want to retire as soon as I can. I don't want to do this thing. I want to go fishing and be on the beach, and I'm prepared to sacrifice more now to be able to get that kind of end goal right now. My challenge to those people would be, are you in the right profession? If you're really keen to get out of it, are you actually doing the right thing? Then there's the second camp who go, I actually love working. I love working. It gives me purpose. I want to enjoy myself more, go a little bit slower in terms of like saving and investing, have more experiences as I go, and I'm happy to work longer. The other component within this as well is maybe you're not either. Maybe you reduce your hours at some point in the future. Maybe you want to get into a position where you like work, but you want to be financially free. So I don't know, if your boss changes and they're an absolute nightmare, you can go, screw you, I'm going to leave. Like everybody wants to be in that sort of position. And the other component as well is, I mean, I don't know if Mike's going to live longer, but people in general are living longer, right? And will people in the future retire at 65, or will they work longer because we're going to live longer?
Yeah, we spoke to the retirement commissioner last week, I think it was, James. And really interesting speaking to her around, how she views retirement in New Zealand, whether or not people will be getting superannuation. Will it be means tested? What age will it be at? There's a whole lot of things that are changing around the affordability of how we look after people who are retired in the country. So our advice is always the same. You cannot rely on the government. You cannot rely on anyone else. You've got to make sure that you are setting yourself up for the retirement you want.
Yeah, absolutely. Are you just going to be like, oh, this person's going to look after me, or are you going to take control yourself? Cool. So coming back to setting those goals, you need to go, okay, so we know the right way to set goals, right? We need to write them down, have a number associated to them, give regular forms of feedback. Am I on track? Am I doing the right things? But everybody's goals are different, like we spoke about before. If you're going, I need a bit of a cheat sheet, James. It's a little bit deep for me on a Thursday to go, what the hell do I want with the rest of my life? Here is what pretty much everybody wants. Everybody wants essentially the same 4 things. They want to live in a certain home. So you might be happy in your home. You might be planning to downsize. You might be planning to upgrade. You might be planning to renovations. What are you going to do? When are you going to do it? How much is it going to cost? Next component, your current lifestyle. So have you got a budget? Do you know how much you're spending? Is that actually realistic? And are you sticking to it? Do you have a surplus? Where is that going? Point number 3, financial freedom. When do I want to be financially free or reduce my hours? What level of income do I want? Some people assume that I spend 100,000 now, but I'm going to spend 50,000 in retirement. That's not how it plays out. People want to travel. People want to spoil grandkids. People don't want to be living off rice and beans. And then the 4th one is around the kids. So depending whether you like your kids or not, some people might want to give them a head start in life. And that looks like a whole range of different things depending on their situation. The most important thing is you've got your goals listed down. Now, the other thing is when it comes to if you've got a spouse, look, financial advice is a lot about relationship counseling. I kind of like, I've got a boxing ring in the middle and I'm trying to keep the 2 parties apart, but you have to get on the same page with your goals. If there is friction when it comes to your goals, it is because you do not have the same, money is just a tool to help you live the life you want to live. So one of you might be prioritizing moving house. The other might be thinking that means I have to work longer. One person might want to help little Timmy into a house. The other goes, screw little Timmy. He can sort it out himself. You need to get on the same page with those goals.
Yeah. And we kind of, as financial advisors, James made a bit of a joke about it, but quite often we are mediating these conversations. And it is really important that if you are in a relationship with someone and you are on those same goals, you have the discussion. Now, nobody wants to go home on a Thursday night after a long day of work and start talking about finances, right? Because inevitably, people aren't great at talking about them. It's embarrassing. Someone might be, not have a history of talking about them, so they don't know how to talk about them. But I promise you, having those discussions and getting on the same page makes it a hell of a lot easier to manage the finances.
Yeah, I mean, the reality is a very decent percentage of divorces are to do with money, right? And you just need to be able to have those conversations and have them frequently to stay on the same page. Now, to those on this call, we've done this to a lot of people. We're going to do a first time ever. We've never done this before. Instead of running through this slide where we have a case study, I'm going to bring up our financial projection software and talk you through it. So Mike, we will see how this goes. So there's the question going. So this is what our financial projection software looks like as an advisor. So we can go based off your age, your assets, your income, your debt, your expenses, one-off expenses. What does this look like going forward? So this couple here are 54. They've got a good household income. They're earning between them, over $300,000. Please do not get stuck on that point. It is, you apply this to your situation. Outside of their home, they're spending about $70,000 a year, which I'd probably say is a little bit light. And they plan to spend $500,000 on an upgrade on their home. So what we focus on in terms of the roadmap to get ready for retirement is rule number one is you do not invest into shares until we have the debt gone on our home. The reason for that is, say you make a 10% return on shares, that sounds pretty good. You take off fees, you're at 9, tax, you're at 6, inflation, you're at 3, mortgage rate is 6%. So we really want to focus on knocking out this mortgage. Then there's the question about investment property. There's really only two ways apart from paying down debt to get ahead: investing in shares, investing into property. We're going to talk in a little bit later about the pros and cons of each of them, but we need to factor in and go, everything in isolation. Do I upgrade my home, downgrade my home, retire early, spend more money? None of it means anything in isolation. It's about how does it impact your situation. These projections are actually quite beautiful. Like if you look at them, they're going to pay off their mortgage, a little bit late, 64, but then we've got some good KiwiSavers. They're going to save a little bit more, and then they erode their capital. And if you can get your projections to last to about 90, we're pretty happy. Now, a common types of questions that we'll talk to clients about is they might go, well, I want to retire earlier. And I'll be like, projections don't work. And I go, well, what's more important to you? Do you want to upgrade your home or retire earlier? Perfect part about this is there is not a right or wrong answer. You get to decide. But let's say we took out the $500,000 upgrade. Suddenly, look at these projections. They've paid off their mortgage in half the time, would have saved a lot of money in interest, and then have a hell of a lot more money that they can save towards retirement. In addition to that, they might go, well, I might use some good debt to potentially buy an investment property. And if we go, all right, well, let's add an investment property to the mix and see if it puts us into a better position longer term. So I'll just do like a very standard, new build type investment property. You can go, these projections are looking even better. And then you might go, all right, well, do you want the ability to work part-time or reduce your hours? And let's say if you retired at 60, what does that look like to our projections? That still looks completely fine. So there are all these levers we can pull in terms of your house, your current lifestyle, when you reduce your income, and obviously factoring in whether you're going to help your kids and those sort of things. So you can see there is no right or wrong with this. It's about having options and you prioritizing what's most important to you. And we might go through this and we might go, hey, you can't do all 5 of your goals, but you can only do 3, or you can do 80% of all 5. Anything to add to that, Mike?
I mean, beautiful numbers, aesthetically dry. It's not the prettiest software in the world, but I guess that's the thing, right? Is with a lot of this, what we're kind of talking to people about is, here is the impact of the decisions you're making over the long term. With the financial plan, it is not set in stone. You have a financial plan, you think, cool, here's where I am, here's how I'm going to get there. You will get to the goal. It's just that the plan will change as your life changes, right? And that's something that the software is really good at kind of incorporating. Are you going to retire at 60? That's what we're planning for. You might retire early. One person might retire early. One person might live longer. Again, it's just about having the clarity around what that means for your financial future.
Yeah, pick what's most important to you and then essentially just reverse engineer it and go, let's say you have to retire with $2 million of investments outside of your home to get $100,000 income a year. A big number. If I go, actually, all you need to do is save an extra $300 a week and you look at your budget, you can go and do that. That's much more doable. So this is the roadmap which we take clients on, which kind of feeds into the projection side. And the first piece is about getting your house in order. So making sure that you've got those clear goals, that you've got a budget, because your income is your biggest asset. And if you don't know what you're spending, then you don't know what you've got left over to work with. If you don't know what you're spending, you don't know when you'll be able to retire or how much money you'll need. Making an active choice of KiwiSaver, Mike, why is that important?
Yeah, so KiwiSaver is a huge part of your retirement savings, right? And you are going to be paying these people a lot of fees for a long time to manage your money. And if you don't make an active choice about the provider and know, how much fees am I paying? Is this a good deal? Is it a bad deal? What is their performance like? And the risk level of the fund that you are in, it can cost you hundreds of thousands of dollars. And, for most people who have a long time until retirement, we would usually recommend a slightly more aggressive fund for them, or a pure aggressive fund, because they can carry, the ups and downs in the market. They don't have 5 years until they're going to need the cash. So again, you can go on sorted.co.nz, look through all the providers, the performance, and make an active choice in 15 minutes, 20 minutes. And that can get you hundreds of thousands of dollars in the future. So if we go, I talked at the top about taking action, and I'm not saying everyone has to swing for the fences with these actions from this webinar and buy investment properties. But if that's the action you take, is making an active choice about your KiwiSaver, 15 minutes could get you hundreds of thousands of dollars in retirement.
Yeah, I mean, we think about, like, in terms of taking baby steps and building on it, setting goals, creating a budget, KiwiSaver, like, awesome return on investment for an hour. But like, the roadmap we take people on after that is, so we want you on the property ladder to ideally own your home. If you're later in life and still renting, that might not be the case. It's a case-by-case scenario. Pay down debt. You've got equity in your home. You look to buy an investment property. Then when your debt's all gone on your own home, then you start to contribute to managed funds to diversify. We're going to talk about property versus shares in a second. And then you map this all out and go, how do I get to financial freedom and understanding those goals?
Yeah, and someone just asked in the chat, what was the website I just mentioned? It's sorted.org.nz or .co.nz. .org.
Yep. Ravi will put it in the chat.
Yeah, Ravi, if you could drop it in the chat. Cool.
Cool.
So here's some other reasonably important considerations when you're looking at your retirement, right? So the first one, make sure you have an updated will. I cannot stress this enough. When someone doesn't have a will, everyone just assumes, it'll go to this person. It'll go to my next of kin. My wife will pick it up. Once it gets stuck in probate, it can be in probate with basically the government sorting it out for you for years. It is a very frustrating time. It can lead to some pretty bad outcomes in the interim, and people start scrapping over money, and that is not what you want. Have a power of attorney or enduring power of attorney. If for some reason you're unable to make decisions, it is important that you have elected someone to make those decisions for you. With your asset structure, make sure everything is set up correctly so that you are helping your family or protecting your assets, or set up to achieve the goals that you want with those assets. That may be a family trust. That may be a look-through company. It may just be in your personal names, But if you don't set it up correctly from the start, people often try and fix it at the end, and it looks like they're trying to hide assets. And all of a sudden, the government is looking at them going, hey, actually, can we give you help in retirement? Because you just sold a house to a trust for under the market value. It all gets a bit crap. Helping your kids. Now, this is one that James and I will lose arguments on almost every time, right? Because it is an emotional decision, not a financial decision. Everyone wants to help their kids. You've just got to make sure that you are not doing it at the detriment of yourself. And if it is going to be at the detriment of yourself and your lifestyle, let's figure out how much that is. Helping your kids can come from a massive range of different things. It doesn't just have to be, here's money, here's a house, here's the assets. You can do a ton of different things for this.
My boy Cooper last night, 2 years old, wouldn't give me a cuddle, would only want to give mama a cuddle. So I'm actually a little bit more fine, Mike, with my plan to cuddle.
That's cool. I just adopted a cat and it broke my finger, so it's out of the will as well. Health insurance. So health and life insurance, no one wants to be reminded of their mortality, but you need health insurance. You need life insurance. Please speak to an insurance broker about this. The right level of cover doesn't always have to be gold-plated, insured to the eyeballs. If you have a plan in place, you should be able to taper that insurance off over time so that you're not hit with these huge premiums every year. And if you get an insurance advisor or an insurance broker, they will be doing annual reviews with you. Well, they should be, which means that you will review the premium and the cover, because insurance companies love it when you just sit and forget, right? And they keep hiking the premiums, and you turn around and go, oh crap, I've got this $3 million life insurance thing. It's costing me a bomb, but I've got no mortgage and I'm about to retire. So do I need this cover? So make sure you get a broker.
Yeah, the other one is with health insurance. So health insurance, all insurance hockey sticks as you get older, because statistically you're more likely to claim. Try your best not to cancel the health insurance just because you're more likely to claim on it. The thing you can do is put a more basic policy in place and then increase the excess to make it more affordable. When it comes to life insurance and income protection, it's just about, having the right levels of cover now. Some people go, I'm not an insurance person. I don't know what the hell that means, because it's not like you get to choose whether something bad happens to you or not. But to Mike's point as well, make sure that you reduce it over time as well if things change. Ravi, maybe just pop the link to book a time with an insurance advisor if anybody wants to have a chat. Oh, Michael, over to you.
So the sprint, guys. So in the Planalytics software, what you would have seen is we were really focusing on paying off that mortgage, right? And then there is a time between when you have paid that mortgage off and when you are still working before you retire. And that is what we call the sprint. And that is the bit we are trying to get you to as quick as possible. Because the longer the sprint, the better your retirement is. Now, we've got some numbers here just to try and, illustrate how powerful it is. Please don't apply the numbers and think, oh, that's not for me, or oh, that's not realistic. It's the concept that we're trying to get to, right? And when I mean the concept and the numbers, if you can't make an extra $500 a week in mortgage repayments, God, who can? I don't know. If it's $50, if it's $50 a fortnight or $100 a fortnight, those are the small steps that are going to get you there quicker because it's over a long time frame, right? So,
Mike, if I can quickly jump in there as well, just remember, like, interest rates won't stay as high forever. They'll come down. Cost of living won't be as high going. I mean, it's not going to come back, but things will get easier. We're just in a really tough spot.
Yeah. So let's say you paid off your mortgage at 50 and those repayments were $4,000 a fortnight, and your only asset is that house you live in. So no other KiwiSavers or anything else. Now, let's say you took that $4,000 and you save or invested them in until you were 65. So let's say you put them into a managed fund at a 4% real return. You will have $2 million in assets by age 65 that is able to provide you with $120,000 of income for the rest of your life. So when I'm telling customers, hey, I want you to make another $50, a fortnight, a week, a month, whatever, repayment on your mortgage, or hey, your interest rate's dropping, can you leave the repayment where it is, right? Because you've already adjusted your budget to this high interest rate. What I'm saying to them is not, let's get this mortgage cleared quicker. It's let's get the mortgage cleared quicker so you have longer in the sprint before you retire, because that's the magic bit, right? Like, that's the bit you're trying to get to.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
Cool. The other question, which does come back to the Planalytics, the projection side and working out your goals. People go to us, how much money do I need? And I'm even starting to see the questions in the Q&A, which is great. Keep popping those in as we go. How much money do I need in retirement? And it depends on all these variables. It's really coming down to, when are you going to retire? If you retire earlier, the money needs to last you longer. If you retire later, you don't need as much. How much are you going to spend? Mike has a far more lavish lifestyle than I do, so Mike will need a hell of a lot more money for retirement, although I'll live longer than him, so, you got to factor that as well. When are you going to travel, downsizing your home, and is leaving a legacy important to you? You need a hell of a lot more money if you're just going to take the cream on the top versus erode the capital over time. Now, I think on the next...
I'm going to jump in there. That is a really tough thing for people to wrap their head around, is that we're not just spending the return on the investment. We are eroding that capital over time. And people get really worried about this and they go, I'm going to run out of money. But the danger is you die with all of this money sitting there and you haven't spent it, right? Yeah. Because you should have almost nothing by the time you kind of jump onto the next life.
Yeah, so there's a book called Die with Zero, which I'm pretty sure was written by an engineer, so maybe some of you would like it. And it's the concept of allocating all of your money. So money represents energy, and you don't want to die with a lot of money. You want to spend it all through retirement, enjoy it as you go. And if you have money left over, based on the projections, either you fly business class, you give your kids a head start, you retire earlier, you do something with it. You find a charity that you're passionate about. You do something, you allocate all of your money. These numbers here are based on how much money, like different levels of income, all retiring at 65 for a couple, including New Zealand superannuation. You can see why it's such a loaded question. How much, I have clients who do spend the 40,000 a year in retirement, and I've got people well north of the 120 as well. It really depends on who you are, and then obviously there is implications, Mike, to who you are.
Absolutely.
Take that as you will.
Cool. All right, guys. So we've talked about setting the goals, thinking about retirement, having the discussions with your significant other if that's relevant. Now, how do we actually get there? What are the things we can invest in? Now, there's a question in the Q&A, which is really around kind of ethical investing and, that perhaps what is a way that I can invest that I think is the right style for me? So we'll talk about that as we run through these, but really there's only 4 places you can put your money, reasonably speaking. 1, cash. We'll talk about that in a bit. 2, property. 3, shares. And 4, managed funds. Now, I'm going to make a quick point about shares before we dive into it. We do not believe in picking direct stocks. Now, if you have a Sharesies account and you think, it's going really well, I've put money in, I've tripled my money. Most of the time, that is just gambling. There are people who do this every day for a job and still can't outperform the market. You might have an amazing spreadsheet. You might have, an amazing EBITDA calculator or something like that. I promise you it's just gambling. Most of the time when we talk to people with Sharesies account, they go, well, I've just invested in Fisher & Paykel. I go, why have you invested in Fisher & Paykel? Well, New Zealand brand, great name, been around for a while. You have no idea who's on the board. You have no idea about their strategy, about the market, about their competitors. It is pure gambling. You may as well go to the casino.
Yeah, and then if you add a layer on top of it, so this is not even picking stocks. This is picking what asset is going to perform best. So you can see we've got gold, we've got commodities, we've got the stock market, we've got cash, we've got bonds, we've got property. And within all of that, there is New Zealand shares, Australasian shares, New Zealand bonds, international bonds, crypto. Like you can just go on and on and on. Yeah. And so to try and pick what is going to perform best, you tell me the trend. There's no bloody trend in here. The whole thing is you want to acknowledge and be honest with yourself and go, you just ain't smart enough to outperform the market. And you want to be diversified depending on your time frame and your tolerance for risk. That's really what you want to focus on.
Yeah. And it was like, I think in my history with the markets and, I'm a finance guy, so I have a bit to do with this. There's only really been one person who consistently outperformed the market, and it was Bernie Madoff, right? And so he's probably the only guy that was any good at it.
Yeah, so we'll send you through his contact details. So this is Mike's heart rate every time he sees me in the morning. No, I'm joking. This is a balanced portfolio with quarterly returns over the last 30 years. So as you can see, there are periods of time where the market will jump 10%, and there is periods of time where it will drop more than 10% in a quarter. So the big thing right here is going, if you are trying to invest for short periods of time, so you've got money where you're going to buy a house or you've got a car, you're going to go on a holiday, and you go, I want more of a return than what a savings account can offer. This is the potential outcomes over the short term. If you are investing over the short term, like Mike said, it is gambling. But if we extrapolate this over longer periods of time, next slide, please, Ravi. Hopefully I got my slide order right. Yes, you can see that the averages over a 30-year rolling average, or even if you look at this over 10 years, we know the outcome from a diversified fund over a long enough period of time. Yes, there is still times that it's, of course it was better to buy a house right now than 2021. But if you extrapolate that over a long enough period, people will go, wow, weren't you so lucky to buy a house in 2021? It just doesn't feel like it now because it's over a short period of time.
Yeah, and people struggle to think on long time frames as humans in general. And I always use the analogy, does it matter if your grandma, because everyone's always trying to pick the best time to buy, right? If your grandma bought a house just off Ponsonby Road for, I don't know, $15,000, do you think it really mattered if that dropped, to $12,000 the next month? Absolutely not. That's a $5 million house, right? Investing over the long term, you are just looking at the long-term trends, getting in the market, and then leaving it the hell alone. The more you play around with things, the more likely you are to make a mistake.
And just to, bang on about the point, 40 out of 50 years, the S&P 500, which is the top 500 companies in the US, the market's gone up. Average return of over 10%, 18 years with a 20% or more gain, 3 years with a 20% or more loss. So over short periods of time, any potential outcome. Over longer periods of time, we know what history says.
Oh, I think I've jumped the slides around here. So do we need to go back to cash?
No, we haven't. Did we jump past the cash slide?
Yeah, we
No,
Okay.
Ravi's saying no.
Okay.
Go back. Go back to the, yeah. Thank you. Ignore Michael, everybody. He's here for the ride. So the other thing you need to think about with your investments is going at some point, your income, your salary going in every fortnight is going to stop. And you need to build up enough assets that can pay you an income when you stop working. So the question is, what assets can we use? Now, Mike, surely you're going to tell me a savings account, term deposits, great place to invest.
The best place to invest. And that's personalized financial advice, James. You can take that to the bank.
Take it to the FMA.
Yeah. So, hey, look, cash. Now, cash is it is useful. You do need some allocation to cash. And, if you have things in the short term, cash is probably where you should keep your money. A good example of that might be a first home buyer using KiwiSaver as their deposit. If you're buying in the next 6 months, very unlikely that KiwiSaver should be in an aggressive fund. That should be in a cash fund because that is, proportionate to the time that you're going to need the money in. Now, term deposits are the only investment, if you can call them that, where your money is going backwards. So leaving it in cash, you are going to have to save really hard to keep up with someone who has it in, say, property or a managed fund or the S&P. So, you might look at the term deposit rate and go, so it's way better now than it was in 2021. I'll throw a whole lot of money into term deposits. Just remember that inflation is eating most of that gain.
Very true. Now, Mike Ravi's giving me the hurry up look, and we've got over 11 questions in there already. Bonds are slightly sexy again because interest rates are higher. They will be part of a diversified portfolio, like a managed fund. Highly unlikely you're going to go buy bonds yourself unless you're a very sophisticated investor. So please move on, Ravi.
Property. Now, I'm a mortgage advisor. James is an investment advisor. So we may have different actually, we don't even have a different opinion on this. We have the same opinion, right? So property is a great asset to get you to retirement. It is a terrible asset to have in retirement, right? And that is a really hard thing to sell people because it's performed so well for them. And they're like, I've got 3 properties and, I'm getting $600 a week in rent from each of them. And, this one is worth, $3 million now in Auckland. I'm still getting bugger all for it. You are asset rich and cash poor if you have property. You are wealthy on paper, but probably not in real life in a cash sense, right? And you can't sell a bedroom to go on holiday. You've got to sell the whole house. And quite often people say, well, I'm renovating my house. I'm investing into my house, and that's going to be my retirement fund. Yeah, maybe. It's just that quite often people don't really feel like downsizing quick enough. And when they do want to downsize, they often want to stay in the same location because their family's there. Those houses are still quite expensive. They don't want to move to, I don't know, somewhere in the far-flung corner of the country where, houses are cheap because they're not next to anyone. So you've just got to remember that property is really good over time. The power of leverage, the power of, just being able to use the bank's money to generate a return on an asset where it is a relatively smooth ride. And I say relatively because there's still ups and downs. You cannot knock that, right? Well, you can knock it, but I think you'd be wrong. It's a phenomenal asset. However, in retirement, it's crap, right? And the reason for that, like I said, you can't get the return you want for that lifestyle in retirement of $600 a week. It's just not going to work from you, right?
Yeah, I mean, just at its core, property will make you rich on paper. Shares will provide you with cash flow. So it's while you're working, you've got income. Property is great. When you need income, managed fund shares are a really good option. So, I mean, we've really laid out the pros and cons. Mike, anything else you want to touch on here?
No, not really. People are really comfortable with property. You can see it, you can touch it, or I can drive by it and have a look at it, even though you can't go near them these days because of the tenancy laws, can't knock on the door. A managed fund, it's a bit more esoteric. People don't, they're not quite as familiar with it. So people are often a little bit more wary of jumping into them. All you are doing is with a managed fund is investing into businesses, basically. There will be other assets in there sometimes as well, but it's really just, someone going, hey, here's a way that you can put money with us and we will manage it in a diversified fashion so that, you're a bit more spread in terms of your risk. And it's so much easier to sell that down over time to provide yourself a regular income than it is to do that with property, right? If you think about the transaction costs involved in selling a property, I paid a real estate agent $52,000 the other day to sell one house. And yep, they did a great job, but that is a lot of lettuce every time you want to get some cash out of your portfolio.
Yeah, good to let the $5 million home go though, Mike. We're just about to jump into the Q&A. We've got 13 questions there. We've got 100 people on the call, so make sure you pop them in if you want to have a chat. If you go, this is all great, but I would like somebody to do the heavy lifting for me, talk to my spouse to make sure we get on the same page, put a strategy together, go through the projections. Essentially that's what me and my team do every day in terms of a financial plan. So if you want to have a chat about a financial plan, we charge no cost for the initial discussion because we want to get to know you and see if a plan's right for you. Scan the QR code.
And if you want to chat to the mortgage team, scan that QR code as well. There'll be some links. What was that? There will be some links in there. I have no idea what that was. There will be some links that are sent out after this as well to book an email in. That is
You're completely thrown off. Did you do that on purpose? No.
Anyway, let's get back on track. Okay, so we can talk to you about how much you might be able to borrow, investment properties. I can give you advice on properties. A lot of people at the moment are asking us if now is a great time to get into the market. And I'm happy to kind of have a chat with you about that as well. There's some really good bargains out there at the moment in the property market. We've got good stock coming online. The official cash rate is dropping. We haven't seen the corresponding price increase yet, which means people are picking up some really good bargains. A lot of people are asking about their kind of fixed interest rate. What should I do? My loan's rolling off, official cash rate coming down. What is my next step? So we're getting a lot of inquiry about that at the moment. So we can give you advice on that too. So book in a time to catch up with us.
You do not want to fix for the wrong period of time at the moment. I tell you that. We did a podcast just the other day where Mike ran through break costs. And one of them was $25,000 if you broke a mortgage. So make sure you are talking to Mike or your mortgage broker about that. Our podcast, so you might go, these guys look like they spend a lot of time together. I tell you, we do. So Mike and I checks and balances. We run a podcast that we do 3 times a week. Had a whole bunch of different Sam Stubbs, Simplicity founder, retirement commissioner, David Seymour, whole range of different people. Check that out if you want to learn more. But let's do the questions, Mike. You ready?
Yeah. I'm ready to go. Cool. Okay, so I'll start. I only at the beginning of my career, having started a little bit later than most. I'm 33 now. I'm interested in some kind of investment or wealth growth to try and get set up for the future quickly. What can I do? James, over to you.
Very loaded question. I would talk about those fundamentals. So one is going, what is your budget? What surplus cash do you have? And then where are you going to allocate it? If you've got some cash, potentially like a investment property is an option. If investment property is not an option, because like we said, make you rich on paper, which for somebody in the 30s could be good. If that's not an option, probably regularly contributing to a diversified share portfolio would make a lot of sense. But there is a huge amount of unlimited variables with this question.
Yeah. Next one. So if you had a spare $10,000, what would you do with it?
Well, Mike and I have just launching our first cryptocurrency this Friday. So now I'm joking. So the QR code. It's, the first thing I would say, if you had a spare $10,000, the first thing you should do is have an emergency fund, and that should stay in cash, and that's not about making a return. After that, it's very similar answer to the one before. It really does depend.
I just moved house, so I'd buy some new furniture.
So you can buy my furniture.
Well, like at the end of the day, right, to give a more serious answer, people often ask us, should I pay down debt or should I invest? A lot of the times, 99.999% of the time, paying down debt before you invest is the way to go. Each age decade, what should debt levels and investment levels be? James?
Yeah, once again, these are very loaded questions. It depends on the level of debt you have and on your income and on your expenses and whether you have kids. That's why like one size does not fit all. And you need to go, what are the goals? If I reverse engineer it, am I on track, off track to have I mean, generally saying if you have a mortgage past 55, like on your own home, that's getting quite tough. If you're thinking, I want an income of $100,000 a year in retirement, it depends how much you're regularly saving, but that's probably like $2 million in assets. So then you got to reverse engineer it. Next one's a goodie, Mike. I don't believe property investment is ethical at all, and company investments seem very questionable to me as well. I assume by company investments they mean shares, value of labor not going to those who created it. Is there some other way to grow wealth besides the exploitation of others?
Not that I can give advice on. James?
Yeah, I don't think we'll probably this person probably
know.
see things from a different perspective. Investment property, everybody, like there is a growing percentage of the population that will need to rent long term, and that will be a lot of their choice as well. So having good landlords who are creating warm homes and looking after people, I think is important. If you don't want to invest into property, and essentially you're saying you don't want to invest into shares, I mean, I said at the start of the webinar, two options.
Yeah, sorry. I'm not being short with the answer. I can't think of anything that I could give advice on. Yeah. Someone said you could start a business. Yeah, you could start a business. That might be a good investment. Yeah.
Yep, potentially. If you buy an investment property and then liquidate it in the future, and then coming back to the projections, I assume makes accrual for capital gains, correct? Is it possible that a capital gains tax will be in place in the future? It is possible. Can the software accommodate for that? Yes, it can. What effect would that have on the projections, do you think? I mean, hypothetically, you're losing a third of the capital gains in that scenario. I think it's quite possible that there is a capital gains tax in the future, and but that would also apply to business sales, shares, pretty much to everything. My only thing would be you're probably overthinking it. Like, it's just is going to be what it is, and you've got to make the most you can with the lay of the land at the moment.
Yeah. How does a trust work? So a trust is just another entity that you can put assets in. I can't go through the tax advantages of a trust because I'm not an accountant. I can't give that advice. We have a whole team here of accountants that can give you that advice though. Trusts can be good for some tax advantages. It can be good for protecting your assets as well. There are some things you need to be careful of with trusts about when you are shifting assets into the trust. I kind of mentioned it before. If you're seen to be hiding assets later in life, that's not a good thing. And then there are ongoing costs associated with a trust as well. You need to make sure you're doing like annual returns as well. So I would speak to an accountant if you're looking for tax advice around a trust. A solicitor, probably if you're speaking to, if you're wanting asset protection advice around a trust to see if that'd be right for you. Yeah.
Cool.
We share the slides. Yep, we absolutely will. Super is expected to be provided in retirement as a question. How much is it?
For a couple, it's 40,000 a year. For an individual, it's 25,000 a year. If you are working, it's a reduced rate. And if you Google New Zealand superannuation rates, you will see them.
Yeah. This is a well-oiled presentation, guys. I thought the wheels came off a little bit when the automatic microphone thing happened, but yeah, it's kind of right.
Was that you, Robbie?
So let's go next one. Can you real risks versus where to invest slide? Best low risk short-term investment? I'm not sure I understand the question. Oh, I see. I think they're asking like, what is the risk associated with each of those investments? Like, what is the associated risk level to those ones we're talking about? Well, cash is probably the lowest risk. Property, I guess, the next. Shares they do present, quite a reasonable amount of risk, especially if you are directly picking them, because you don't really know what you're picking. I'm assuming everyone is about the same. And a lot of times people associate the risk of shares with the company. To my comment before around people picking Fisher and Paykel, because they go, safe as houses, it's been around forever. You just don't really know. And then there are a lot of things further down that risk spectrum on a general sense, like crypto, NFTs, alternative investments, metals, that sort of stuff. So yeah, I think that's probably, but again, all of the risk needs to be wound back to have a look at what is your situation and do you want to take that risk on and how much of your portfolio is allocated to it.
Yeah, a lot of people talk to me about commercial property as well. Risk with commercial property is a tenant. You don't have a tenant. A lot of the value is gone.
All yield based. Yep. Best low risk short-term investment, James?
Yeah. So a lot of banks have like 32-day notice saver accounts. Kernel Wealth has a cash fund that I don't mind. They're probably the main ones.
And you'll see we're just talking about cash there, because really short-term investments should usually just be kept in cash. What if you're in an age gap relationship where one partner reaching retirement 10 years sooner? How does this affect the savings dynamic? James, definitely for you.
Yeah, I mean, quite a common scenario that we see. The question is, what are those? Are they both retiring at 65? Is one working till 70, the other working till 60? Like, what is happening? That's probably the main question to have around the dynamics. And then you might have a longer time frame to invest because you might have the younger person's income for a longer period of time. That means you can have higher, a more aggressive fund or whatever it might be. So yeah, there are some different components there.
Cool. Investment property, when is a good time to cash in relative to retirement age? That's probably, you go, James.
I have a rule with investment property. You don't sell it unless you have a reason to sell it. So one thing I can guarantee you is you look up the value of the house 10 years, assuming you haven't bought some kind of crappy apartment, and it'll be worth twice as much in 10 years' time. So you've got to think, if I'm going to exchange future gains, what am I going to get? And 9 times out of 10, it's lifestyle or being help kids or whatever it might be. So it's really about at what point do you need income? That would be the main driver.
Yeah. So maybe a 50-50 split between managed funds and property could be a good option. That's definitely personalized advice.
Yeah, generally speaking, I think like a heavier weighting towards property is right at a younger age, and then diversifying depending on like whatever the goals are. And if you have it depends on the level of wealth as well. If you have more wealth, you can hold more in property longer term. If you have less, you'll probably have to sell it and put it like 100% into funds.
Yeah. What is the difference between a mortgage advisor and a financial advisor? Mortgage advisors are financial advisors. Not all financial advisors are mortgage advisors. Who is the best to have a chat to regarding investment properties for the future? So as a mortgage advisor, I just give advice on investment properties, debt, mortgages, financing things. Everything I do is structured around the debt side of things. James is a financial advisor and a wealth planner, is probably his specialist area. Gives you long-term planning advice, right? So that Planalytics software, talking about that. Here's where you are now. Here's where you want to go. Best to chat to regarding investment properties for the future. Probably because you put for the future, it is James. If you had said, I want to buy an investment property, I need to do it, then you would speak to a mortgage advisor. Although we can give you advice around investment properties for the future as well. But I'd say probably James over me. So financial advisor over mortgage advisor.
Mike and I need each other. I need Mike to get the money, and you need me to give you the why to buy it. The other difference is just look. So like financial advisors, just good looking bunch.
You do a podcast. No wonder you guys have a polished presentation. We're also best mates. We live about 600 meters down the road from each other. We spend about 90% of our time together.
Yeah, and we're liking each other today.
Yeah. What is the standard deposit needed for a house? I've seen everything from 10% to 25%. I have no idea why. The standard deposit you need is 20%. You can buy a house with as little as 5% deposit, though, in some instances. You need 30% for an in situ existing investment property. A new build investment property, you can get away with as little as 10%, but generally 20% for those. So anywhere from 5% to 30%, depending on the type of property you're buying, but 20% is what the banks like you to have. And there's 1,000 different ways you can get there, even if you don't have the cash in your pocket. Have a chat to a mortgage advisor.
Yeah, that's right. Opposed to trying to work this out yourself, just talk to the person, go,
Outsource
this
it.
is what I want to do. It's
Yeah.
amazing, Mike. How often do people go, oh, I think I'm a while away from it, and you're like, nope, you can do it now.
They're my favorite conversations to have. We do a first home buyers webinar, and they are the best conversations to have. You're like, you can buy a house now. And this is not a sales pitch for me, but I highly recommend you speak to a mortgage advisor over speaking to the bank. The bank will say something to you like, yeah, this is the lowest interest rate we have at the moment. And that might be a 5-year interest rate. That is usually a terrible decision at the moment. They can't give you advice. They can just give you information. People make the wrong decisions when they speak to bankers. Next one, because we're running out of time. To not be cash rich in the bank, should you consider buying cheaper or less nice first house and have this as easier to pay off rather than your ideal house situation? So your first house is never really your ideal house. The quicker you can clear that mortgage down, the better. But that's not the only reason people buy houses. Like absolutely, like a cheaper house will allow you to pay it off better, to leverage up into the next kind of house you want to buy. But people move house for a lot of different situations. Like, you know, you might want to live in a certain area. You might want to send your kids to a certain school. So yeah, I would say, yeah, don't go all out on your first house. It's just a stepping stone for your ideal house.
I'm cracking up laughing because I've seen the most engineering comment ever. Mike, the time of your watch looks wrong. Just saying. There's a time on your watch, right?
No, it's a wind-up watch. You have to adjust it every day. I can't be bothered. It's just a bracelet, really. Yeah.
Love the engineering community. Okay, next question. To not be cash rich in the bank.
We just said that.
Oh,
James.
cool. Okay, next one.
Next
Sorry, I got distracted by the watch. KiwiSaver
versus
the shares.
Sharesies.
I'm
Yeah.
kind of anti-sharesies a little bit,
Same.
just because it encourages people to pick their own investments opposed to just investing into something diversified. Rule with KiwiSaver, and this is good for everybody, you want to maximize it. So you want the maximum employer contributions. If you're self-employed, you want to get the government tax credit. You don't really want to put anything more in there because it's locked up till 65. The rest should then be going into an unlocked version of KiwiSaver, because KiwiSaver is obviously just a managed fund or focus on paying down debt.
Cool. So I have 2 properties. Retirement would be 36 years. Are you suggesting I sell these by retirement rather than keep the same as income? That is personalized advice. We cannot do that on this call. You need to book in a time to speak to us.
How can we properly count inflation when thinking about retirement? You do it by applying like a net real return. So assume opposed to saying property you got 5% or shares got 10%, deduct 2 or 3% for inflation. That's the best way to do it.
Cool. Is there a point in retirement where life insurance is no longer relevant? Yes. It seems like the increasing monthly payments become too much if one is to live off investments already. James?
Yeah, if you are financially free, you 9 times out of 10 don't need life insurance because you just be chucking more money on the pot. That's the same with income protection. The whole thing is, if you died tomorrow, would the people you care about be okay? If you got sick, would you and the people you care about be okay? That's the framework to apply.
If you have a good income, would you ever consider owning an investment property that is cash flow negative, but likely to have good capital gains, i.e. in a growing area? 100%. Most investment properties in New Zealand are cash flow negative at the moment. It's just about, you know, let's say you have to top up 10K per year, and you're getting, I don't know, a 5% return on $1 million property. I would swap that 10K for that 5% return every single time.
Cool. Last question, so we're just going to fire through. Is there a free version of that software? No, there's not a free version. You come to us for a financial plan, or I think you can pay for it, and it's like $600 a year or something. How can we properly count for inflation? We've done that one. What is the minimum amount to invest in managed funds, and how does the tax on any returns work? You pay tax on the returns. The fund should take care of that. There's no minimum with a lot of them. Investment platforms. What ones do we think? What are the pros and cons? I quite like Kernel, like just because it's funds, but the main rule is funds, not individual shares, diversification.
And just watch, because Sharesies gets a clip every time you do something. So the whole app's designed to get you to keep doing things. Yeah.
What about not buying a house at all and only investing into funds? Yep, we've got clients where we've done those plans as well, or even you have an investment property, but you continue to rent. And last question, is there a yearly service checkup for your finances you offer? Yep, we do financial reviews for all of our clients. So you can see all that stuff on the website. All right, finished 1 minute over time. Exceptional group, Mike. Lots of questions.
Awesome.
So we will be doing another one of these webinars, another 4 to 6 weeks. So please make sure to join that one. There'll be a survey that comes out. Please make sure to fill that out to let us know what you thought of this so we can pass it on to Engineering New Zealand. Otherwise, we will catch you next time.
Cheers.